Welcome to the channel. I'm the Swedish dividend investor, and today we're going to do a valuation on PepsiCo, ticker PEP. Before we begin, I just want to say this is not financial advice. I'm just a guy on YouTube who wants to help people think differently about investing. Make sure to read the full disclaimer in the description down below. I'm sure Pepsi doesn't need a detailed explanation, but here is a short summary of their business. PepsiCo is a leader in snacks and beverages, owning household brands including Pepsi, Mountain Dew, Gatorade, Lay's, Cheetos, and Doritos, among others. The company dominates the savory snacks market, being the new beverage provider in the world, behind Coca-Cola, with diversified exposure to carbonated soft drinks, as well as water, sports, and energy drinks offerings. Convenience foods account for approximately 55% of its total revenue, with beverages making up the rest. Pepsi owns the bulk of its manufacturing and distribution capacity in the USA and overseas. International markets make up 40% of total sales and 1/3 of operating profits. They have released their latest earning, so we're going to take a look at it and make our evaluation. I use both SeekingAlpha and Morningstar, and as always, compare the numbers to the company's annual report to see if the numbers match. You can just Google the company name plus investor relations. Look at the 10K for the annual report. If it has hundreds of pages, just search for statement or consolidated statements. And it looks like the right numbers. We're just going to enter the current dividend on the first page of my spreadsheet and head over to the data page. I'm going to spare you the boredom of watching me punching in the numbers, and I will be back when it's all done. Alright, here are the numbers. If you want to take a look, you can just pause the video. Instead, let's take a look at the charts here. We can see their cash flow is kind of steady, and between 2020 and 2024 it did grow. We also see steady increase in revenue and net income. They have taken on more debt the last 2 years. However, their cash covers the debt in an instant, so I wouldn't say it's a problem for now. Here we can see the dividend has been hiked for 53 consecutive years, making them a Dividend King. About 7% compounded annual growth rate for the last 7 years for the dividend. Very nice. Moving on to my short metrics I like to use when I'm looking into companies. I have this on the left side. They don't all have to be yes, I just want to see a short summary of numbers I care about to get an overview. Heading over to the valuation, we will use a 5-year average for the free cash flow for the DCF. Why 5-year average? Because it smooths out unevenness and gives us more of a conservative number for a better margin of safety, so we can be forgiven a little if we use too high growth numbers. 10% discount rate, but as we can see, the average multiple the market gives for their cash flow is a bit high, in my opinion. So we're going to use a lower multiple. For this example, I've gone with 25 for normal case, 30 for best case, and 20 for worst case. Looking at the growth for the free cash flow is kind of all over the place. So I take the cash flow from 2020 and grow it for 5 years until I hit the last reported cash flow. That's about 3% annual growth when smoothed out. But since we use the 5-year average free cash flow, we can be a little less conservative. We're going to enter 5% for the normal case, 6% for the best case, and 2% for the worst case. Probability 60-20-20, giving us a present value of 155 billion and 70 million, and with a margin of safety 145 billion and 6 million. This is compared to the market cap. Before we move on, do you own Pepsi? Let me know in the comment section. Moving over to the dividend valuation. The terminal multiple is 27, or around 3.7% yield for a normal case, 30 or 3.3% for the best case, and 22, or about 4.5% yield for the worst case. Remember, this is the yield the market values from the companies 10 years from now. I've just gone with average on the yield. Growth for normal case, let's use 7% for 10 years. Best case, 8% and 5% for the worst case. We get a present value of $147.86. And with a 5% margin of safety, we get $140.47. That is per share and not market cap. Going over to my least favorite method, the earnings valuation. We are using the 5-year average earnings in billions, and we can be a bit more generous with the growth rate, since this is a bit lower than their current earnings. Instead of the 5.5 average growth, we can use 7 for normal case, 8 for best case, and 3 for worst case. For the terminal multiple, we can use the current PE of around 20, best case 25 and worst case 15, giving us a present value of 188 billion and 34 million. And with a 5% margin of safety, 178 billion 920 million. So, heading over to the first page again, we can see the only fair valuation for a 10% annual return is the dividend valuation, but without margin of safety. It's quite a bit to go on the cash flow valuation and pretty close on the earnings valuation. We can also see the payout ratios. It's a bit high on the cash flow side, but 75% for the earnings payout. I think that's their average for the last couple of years. Mixed valuation, adjusted for share price, shows us a good price for a 10% annual return is somewhere around 130 or 125 for a margin of safety. This is just based on my estimates. Yours may differ. If I would buy Pepsi again, I could see myself starting a position at around 130 just because of the stable business model, strong and growing dividend and a strong balance sheet. That's it for this one. If you would like me to take a look at a company, post it in the comment section down below. If you enjoyed the video, give it a thumbs up and consider supporting me by subscribing. I am the Swedish dividend investor and I will see you in the next one. Ha det gött!